If you want to grow your wealth effortlessly, then index funds are your secret weapon. But here's the thing, it's not just about picking any index fund. What most investors never learn is the proven strategy behind why index funds consistently outperform 88% of professional investors. These are going to be the 6 key principles about index funds that will revolutionize your investment approach. And I can assure you that anyone who follows these principles are going to watch their portfolio soar to new heights. What's up, everybody? I'm Rashida, and I'm your guide to smart money moves. I started my investment journey when I was 17 years old. I have grown my portfolio to over $1 million, and I did it all on a police officer's salary. And it is my mission to show you that it's possible for you too. So let's go. In 1975, a game-changing idea came along that would change investing forever. While Wall Street big shots were charging huge fees to pick stocks, one company decided to simply buy everything in the market. And this hands-off approach went on to beat 80% of professional investors over the next few decades. And how they do this? They did it by creating index funds. So first, let's break down exactly what an index fund is. Imagine you're buying a slice of the entire American economy in one simple purchase. That's essentially what happens when you invest in an S&P 500 index fund. You get tiny pieces of 500 of America's largest companies. Think about it this way. Every time that you buy something from Amazon, or you get coffee from Starbucks, or you use your iPhone, if you own an index fund, you are actually a partial owner of these companies. You're not just a customer anymore. You are an investor getting a share of their profits. And so while most investors are frantically buying and selling stocks, trying to time the market, index investors are quietly building wealth through 3 powerful advantages. The first advantage is that you get automatic spreading of your money, aka diversification, across hundreds of companies. Think about it. Instead of putting all of your money into just one company like Nvidia or say an Enron and just hoping for the best, your money is split across hundreds of different companies. If one company has a bad year, it barely affects you because you own so many others. And so it's like not putting all of your eggs in one basket. Instead, you're spreading them across hundreds of baskets. The second advantage to owning an index fund is that you are going to pay much lower fees than an actively managed fund. Actively managed funds can charge as much as 1% or more for their services. That means 100 out of every $10,000 you invest goes to fees. Now, on the other hand, with an index fund, they may charge you anywhere from $3 to $5 per $10,000 that you have invested. And that difference may seem small, but over 20 to 30 years, it could mean tens of thousands of dollars more in your pocket. And the third advantage is that you're going to save on taxes through less trading. When a fund constantly buys and sells stocks, that creates taxable events, meaning you owe more in taxes each year. Index funds barely trade at all. They just buy and hold the same companies. Less trading means lower taxes, which means more money stays invested and growing for you. And the best part about index funds is that you don't need to be a Wall Street expert. Whether the market goes up or down, you own a piece of the entire economy. When Apple releases a new iPhone, you profit. When Microsoft launches new software, you profit. When Amazon changes the way humans shop forever, you profit. Index funds can track different markets. So you have stock index funds, which are going to track things like the S&P 500 or the Russell 2000, okay? When people say that I buy the S&P 500, well, you can't actually buy that, but what you can do is buy an index that tracks that. Again, that's the top 500 companies in the United States of America. And you also have index funds that will track the bond market, international markets. You have, industry markets. You could buy index funds that track things like the energy sector or industrials or technology. It's very broad as far as the type of index fund that you can buy and what your focus is for your investing. The single most important thing when you choose an index fund is going to be the fee, okay? Or the expense ratio. That is the amount that you're paying to hold that index fund every single year. And so think of fees as a hidden wealth killer. The difference between a 0.5% and a 0.04% fee is huge. It could literally mean the difference between you keeping hundreds of thousands of dollars over a long period of time. And so what you want to look for is an index fee that keeps its expense ratio below 0.2% and preferably below 0.1%, because there are plenty of them out there. You just have to check and make sure that your fund that you select kind of aligns with that. You also want to make sure that that fund you're looking at is easy to buy and sell, that it has a history of closely following the index that it's supposed to be mirroring, and you want to make sure that you're holding something that is big in size, something over $1 billion of market cap. Okay, now that you understand the basics of index funds, let me save you some expensive lessons that I have seen many investors learn the hard way, including myself. These are going to be the 3 biggest mistakes that can derail even the smartest investors, and more importantly, I'll show you exactly how to avoid them. The single biggest mistake that anyone new to investing is going to make is to try to time the market, okay? And market timing is basically trying to guess when to buy and sell that investment. Many investors try to buy when they think that the market is low, and then they try to sell when they think the market is high. But doing this often leads to very poor results over a period of time, and more importantly, you're gonna miss chances for growth. Typically, when it comes to markets, if you are not in the market, you're going to miss some of the biggest gaining days because you were sitting on the sidelines. And over a long period of time, most of the gains made in the market are done over a very small number of days. So you can't miss out on those days, or else it's going to crush your long-term returns. And another mistake that I see beginner investors make is that they try to spread their investments out too broad. Now, while spreading your money across different investments is a good thing, having too many index funds creates unnecessary complexity to your plan. Many index funds are already going to give you broad exposure, so having multiple funds that track similar indexes can actually weaken your investment strategy. And again, high fees is going to be a huge mistake for anyone that's not paying attention when they're selecting their funds, okay? Because if you choose an index fund with an expense ratio above 0.2%, then you can hurt your long-term returns. That is a fact. The power of index investing comes from low cost, okay? So paying higher fees defeats one of its main advantages. Okay, so now that you know what index funds are, you know what mistakes to avoid, let's get into the exciting part, how to actually start investing. I'm going to break this down into 3 simple steps that anyone can follow even if you have never invested before. First, you're going to need to pick a trusted investment company to handle your money. The 3 biggest and most reliable companies to pick from are going to be a Charles Schwab, a Fidelity, or Vanguard. And so here's what to look for when you're choosing between them. Account minimums. Fidelity and Schwab will let you start with as little as $1, so you can't make the excuse that you don't have enough money to invest. Now, Vanguard will sometimes require more money. It just kind of depends on which fund you're looking at. They may require you to buy at least 1 share of the index fund that you're hoping to purchase. You also want to consider website experience, okay? Fidelity and Charles Schwab definitely have a more modern, user-friendly website. Vanguard is a bit more basic, but it still gets the job done. And customer service is going to be super important, especially if you're just getting started, because you may have a lot of questions, okay? All 3 of these brokerages do have phone support, but Fidelity and Schwab also have local branches that you can visit if you want to have a chat face-to-face with somebody. You have that option with those 2. Educational resources is also important. Each platform is going to offer free guides, free videos, and tools that are going to help you learn, and I highly recommend you take advantage of that. Now, my personal recommendation for beginners is going to be Fidelity, because they actually offer some index funds with 0 fees, completely free to invest in, and their website is really easy to use and get around in. Next, you're going to need to choose the right type of account, okay? This decision alone can save you thousands of dollars in taxes. So let's break down your options. The first stop is going to be tax advantaged retirement accounts. So your traditional IRA or 401k. Your contributions here actually reduce the taxes that you pay now, and then you pay the taxes when you withdraw those funds in retirement. The next option, and my personal favorite, is going to be the Roth IRA. You pay taxes now, but you never pay taxes on the investment gains or the withdrawals in retirement. It can't get any better than that. Next is going to be your workplace plan. Okay, so your 401k. This often comes with free money through your employer, matching anything that you put in up to a certain amount. So always take advantage of this option first, because it's going to give you risk-free return on your investment right out of the gate. And some employers now offer Roth 401ks. So if you have that as an option, please take advantage of that, because your investments, again, are going to grow tax-free for years, and you don't have to worry about paying taxes when you take it out. That is king. Now, your contribution limits are going to be as follows. The government is going to allow you to put up to $7,000 per year in an IRA or an individual retirement account, and they're going to let you put up to $23,000 per year in your 401k. These numbers are as of 2024, and they usually increase this over the years. Okay, the next tier is going to be your regular investment accounts or brokerage account. Okay, now there are no tax advantages with these accounts, but there are no contribution limits. Okay, you can put in as much money as you want in these accounts, and it's more flexible because you can withdraw those funds at any time. You don't have to wait until retirement age. And so these are great for investing after you've maxed out all of your retirement account options. And last but not least is a sleeper account that too few people take advantage of that are eligible for it, and that's going to be the Health Savings Account, or HSA. This account is triple tax advantage. The money you contribute is not taxed, it grows tax-free, and they let you withdraw it tax-free. Now, obviously, you're going to have to use that money to go towards medical expenses, but we all know how expensive healthcare is in the United States, so it's going to be a great account to have if you qualify for it. And your HSA actually acts pretty similar to an IRA. Okay, once you have over $1,000 in there, then you can begin to invest that money and allow it to grow over a long period of time. That's definitely going to come in handy as you get older. Now, in order to qualify to open an HSA, you have to have a high deductible health plan. Okay, that is the only way you'll qualify for it. So if you work for an employer that has really low deductible health care for you, you're not going to qualify for an HSA. And now the contribution limits for an HSA as of 2024 is going to be $4,150 for individuals. Now, once you've chosen your platform and your account type, here's exactly how to get started. Go to the company's website, click on Open Account. You're going to have to enter your social security number and bank information, fill out the application, and bam, you're ready. Next step is going to be to fund the account. You're just going to link your bank account to the investment account, okay? Kind of like connecting your Venmo to your bank account, same thing. Then you're going to choose either a one-time transfer to get started, or my preferred method is going to be to set up automatic transfers from your bank account or your paycheck. Now, setting up automatic investing is going to be so important if you really want to knock this out of the park long term. Pick your index fund and set up automatic buying every month or every paycheck. Okay, start small if you're nervous, but even $50 a month can add up. Okay, and increase your investment amount over time. Every time you get a raise, make sure you're putting like 60-70% of that raise toward your investments. There's one thing in the settings that I want to make sure you take a look at, and that is your dividend reinvestments, or DRIP. This automatically reinvests any dividends that you receive, and that is going to be really, really important for the long-term growth of your investments. You don't want those dividends just sitting off to the side. You want them back in the market working for you. Make sure you set up account alerts to notify you of any large changes that happen to your account, and you want to make sure that you save your tax documents as soon as they become available. Remember, the key is to make it automatic, okay? When you invest automatically every month, you don't have to worry about when to buy and when to sell. You are basically putting your wealth building on autopilot. Now that we've covered all that, I need you to understand this. Every single day that you wait to start investing is a day of potential growth that you will never get back. I know that investing can feel overwhelming at first. I get that. I've been there. I felt the same way when I first started. But what I've learned after helping so many people get started on their own investment journey is that the hardest part isn't understanding index funds or picking the right platform. Hardest part is to take that first step. And so remember, you don't need a lot of money. Obviously, some of these companies let you start with as little as $1. You don't need perfect timing. The best time to start was yesterday, but the second best time is today. And you don't need to be a market expert, okay? That is the beauty of index funds. Index funds are going to do the work for you. Now, if you've made it to this point in the video, you have already taken a huge first step just by learning about index funds, okay? Now it's time to put that knowledge into action. Your financial freedom journey starts today. And hey, if you found this video helpful, please share it with a friend, subscribe to the channel. And if you are someone that wants to know why net worth explodes after the point of $100,000, because you're going to get there, check out my next video. I will see you guys in the next one. I'm Rashida and I'm out.